and I've got a net positive percentage of real estate agents for 2 months in a row now saying they're seeing more people at open homes. No indication that the numbers are large. We're not talking about a big wave of people jumping into the market as happened after those first sort of 2 months of the lockdown in early 2020. Hello again, everybody, and welcome to another Tea with Tony, even though there is not actually a cup of tea in front of me. This month, NZHL have requested that I have a look at interest rates in the context of sort of two things there. One is the February 22 decision by the Reserve Bank on the official cash rate, so that's monetary policy changes, and also fixed interest rates and what's been happening there. We've had a little bit of movement, some interesting discounting of rates going on by some lenders behind the scenes as well. So have a look at those couple of things there. Also have a look at the housing market in terms of the housing sales, the volume of activity, fairly weak out there at the moment. A lot of real estate agents maybe thinking about something else to do for a wee while. And also I've been asking if I could just have a little bit of a pick on where house prices are going to go. That's sort of easy. No one has got their house prices right in, I don't know if any country around the world maybe, since before the global financial crisis. So I will give you a pick. I just don't expect to be right. What I hope to do is recognise early on when I'm going to be wrong. So I know that's not necessarily what people want to hear, but that's the way it is in this very uncertain world that we live in. Which brings me then to the first topic there, and that's monetary policy. One of the surprises, of course, for the pandemic, well, the first surprise was that economies didn't collapse, and with the assistance of record low interest rates here and overseas, the removal of LVRs in New Zealand, the housing market boomed, the Reserve Bank was printing money, inflationary pressures developed to a far greater degree than any of us, of course, anticipated, and this was the big surprise in the latter part of last year. The October 18 inflation number higher than expected. That led to about 0.5% going on the fixed mortgage rates there. And then the Reserve Bank responded on November 23, warning of recession. They gave a record increase in the official cash rate of 0.75% and lifted their prediction for the peak in the official cash rate from 4.1% to about 5.5%. And so then we're all waiting for, 3 months until the next review late in February, just to see what sort of economic information would come out on the economy. And of course, what we saw was quite a collapse in business and consumer sentiment here in New Zealand. And in my various monthly surveys, we could see things falling away quite tremendously with regard to the housing market in particular. And also we saw some slightly better than expected numbers on wages growth, as in, this is, I guess, a strange one, better than expected from an inflation point of view, wages growth slightly slower than we were thinking, and jobs growth was only about 0.1% during the December quarter. In the context of a central bank fighting inflation, these are good things that we want to see. And so we all expected that the Reserve Bank would, I guess, be slightly more conciliatory in its comments on February 22, and they were to a very small degree, and they didn't repeat the 0.75% increase in the cash rate. They only increased the cash rate by 0.5%, so it now sits at 4.75%. They left the peak at 5.5%, but just shifted it out maybe 2 or 3 months closer towards the middle of the year rather than in April. Now, there was a lot of interest in whether they might either not raise the interest rate or only do it by 0.25% in light of the terrible flooding in Auckland and Northland at the end of January, and then, of course, Cyclone Gabrielle as well. Well, as myself and a number of other economists, not all of them, but most of us were pointing out, Treasury had already predicted before the cyclone that the flooding in Auckland and Northland was going to add 0.4% to the inflation rate this year. And of course, with the extra pressures on availability of fruit and veggies, etc., from the cyclone and then the repairs, there's extra inflationary pressure coming along. So these weather events, they make us poorer. They can depress economic activity in the short term, but they add to inflation. And so the Reserve Bank made it fairly clear that when they were debating what they were going to do, the choice was between increasing the cash rate 0.5 or 0.75%, not 0.25 and 0.5%, and no indication at all that they were thinking about having a pause there. So the impact, like I say, of the flooding, etc., it is inflationary. The Reserve Bank, however, will have a good look at what the data show and what we learn more about the economic impact over the next few months. So there is still some scope for some change there, but people have to, I think, keep in mind that when we look at the images, and of course 10,000 people are displaced by these events, we have to put that in the context of a 5.1 million population. It's less than 0.2% of the population. So just to put a little bit of sort of unfortunate perspective on it. Now, switching to what's been happening with fixed interest rates, with the world seeing some better than expected inflation numbers early this year, and also some of these things in New Zealand as well, the cost to New Zealand banks of borrowing money in order to lend out at fixed interest rates was going down from right at the end of last year and through January. And so about 6 weeks ago, we saw a round of reductions in fixed mortgage rates. And I didn't expect it would happen quite so soon, but you may recall soon after the November 23 monetary policy change, and the fixed mortgage rates went up another 0.5% back then, I was saying I was 90% confident that the fixed mortgage rates for 2 years and beyond had seen their peaks, and with the 1 year rate it was 50-50 call on what would happen there. Well, I see a number of other people now, in light of these recent reductions in fixed rates, saying that yeah, we probably have seen the peaks for those rates, but nobody should be thinking that we're going to see them fall all that quickly, because things have changed again over the past 4 weeks or so. The economic data in the United States have been stronger than expected, especially with regard to growth in job numbers and retail spending. An inflation number which comes out each month that the Federal Reserve looks at was quite a bit higher than expected. This has led to the cost to New Zealand banks of borrowing money going back up again, and maybe with a little bit of an extra increase in local interest rates, because we can see that with the passage of time, business pessimism about the economy is easing, employment outlook slightly improving. None of the changes are major, but it does mean for now we shouldn't really be expecting any further extra cuts, generalised cuts across the board in those fixed mortgage rates. But of course, that's not the most interesting thing out there. As I pointed out a wee ways back, the dwelling sales in the country are very low. Mortgage sales business for the banks are very, very low. They're not meeting their sales targets in that regard. And so it's always a matter of, well, how will they respond to that? Well, we saw one lender respond with a 4.99% rate for just 1 year fixed, basically writing business at a loss. We saw a couple of others looking at 18 to 24 month discounted rates, so 5.99%. And this is the sort of thing we're seeing different versions of in Australia, where also the real estate sales are low and the banks are writing some business at a loss. Now, of course, a key driver in New Zealand is that about $170 billion worth plus of fixed rate mortgages come up for renewal in the next 12 months. And that represents quite a bit of danger for the lenders, because if another lender is offering an attractive interest rate in an environment where everybody's finding their interest rate going higher, one could easily find one's mortgage book falling away. So the banks have had a bit of experimentation with some discounted rates out there. There's some experimentation going on with the 1% cashbacks, etc. And it'll be interesting to see what they next choose to experiment with as they learn where the sweet spot is in terms of you and I as borrowers. What do we react to? Some people reacted by breaking their mortgage fixed interest rates early and resetting at one of these lower rates, and maybe that's something just to keep in mind. I don't normally talk about that. It just makes things exceedingly complicated, but I think it's reasonable to expect that if you have a fixed rate maturing, coming up for renewal in the next few weeks, 2 to 3 months maybe, keep an eye out for bank special rates that are going to be on offer and negotiate. Definitely negotiate, because we can see through the media some reports that people have gone into their bank and said, make me an offer or I'm taking my business elsewhere, and some good offers have been made out there. Having a look at what's happening there with house sales, I've already mentioned things are being very weak, and this is driving banks to discount some of their fixed mortgage rates out there. In January, the number of dwellings sold around New Zealand was about 2,800. It was the lowest number of sales for the month of January on record, going back to about 1993. It was only about 57% of the average number of dwellings that get sold in a January over that 30-year period. Things very, very weak out there, of course, as a lot of people have pulled back from the housing market, following on from the monetary policy tightening of November 23 last year. Now, I think it's reasonable to expect that sales are still going to be fairly weak for the first half of this year. But the most interesting development in the residential real estate market over the last wee while has been the return of first home buyers. This is one reason I run these monthly surveys of the mortgage advisors, real estate agents, property investors, consumers, all these sort of things, to get coal-face, real-time insights into what's happening out there. And we can see the first home buyers are stepping back into the market. I saw it first of all about 5 weeks ago or so with my survey of mortgage advisors, and now that's been confirmed with my survey of real estate agents as well. And as I might have noted in one of my weekly videos, there's a number of factors encouraging the first home buyers back in. House prices, of course, are a lot cheaper than they were previously, and yet people's wages have gone up on average 18% from where they were about 3 years earlier. There's some new pressure appearing in the rental market, bit of a migration turnaround, a bit of a boom out there, tourism growing strongly, etc. As well. And also the banks have eased up on some of their lending criteria. So there's a few other things in there, but the first home buyers are moving back into the market, and I've got a net positive percentage of real estate agents for 2 months in a row now saying they're seeing more people at open homes. No indication that the numbers are large. We're not talking about a big wave of people jumping into the market as happened after those first sort of 2 months of the lockdown in early 2020. So don't get overly excited thinking all of a sudden things are going to turn around, especially because I don't expect that investors are going to be following along for a while. There remains no indication in any of my surveys that investors are pricking their ears up and looking to hop back into the residential property market. They've got their accounts to get in order with their financing costs going up, and we know, of course, a lot of investors do have some relatively high debt for their property investments. There's been some, uncertainty about where rents are likely to go, extra uncertainty about the Healthy Homes legislation and exactly what timetables still some people seem to be working on are there. And also, of course, as each year goes by, a decreasing proportion of interest expenses can be deducted against rentable income for taxation purposes. And of course, it's an election year. There's a lot of uncertainty. National have said if they get back in, they will restore interest expense deductibility, take the bright line test back to 5 years. But I mean, we've learned, I think, to distrust the polls. So my feeling is the investors are still largely going to be out of the market for most of this year. It seems reasonable to expect real estate turnover is still going to be relatively low, but I'm expecting a bit of a bottoming out generally towards the middle of the year. Which takes me to the final thing to talk about there, which of course is prices. I expect prices will continue to decline for the next few months. In my survey of real estate agents, I ask explicitly about this, and there is no sign from the real estate agents that they are seeing easing downward pressure as yet. We've got high levels of consumer pessimism generally out there. There are these concerns about the high level of interest rates, people rolling on to something higher, and generally what that is going to be doing out there. So I think the risk is that house prices do fall further. But we are, I think, building up towards maybe a turning in the cycle in the middle of this year. I'm not looking for any sudden jump up by any means, not with still a risk the economy could have a recession this year. I'm still personally 50-50 on it. But do keep an eye on, some of the interesting underlying things I like to try and emphasise and write about in my columns and publications. One of them I quickly mentioned a few minutes ago, net migration numbers have turned on a dime. 6 months ago, New Zealand had a net migration loss of 16,000 people. Now we've got a gain of about 16,000 people. Tourist numbers are growing strongly, so properties are going out of the long-term rental pool back into Airbnb. You've also got the foreign students returning relatively early as well, earlier than was expected. And so we're starting to see early, not convincing as yet, but just some early signs maybe of some pressure returning in the rental market there. And one might expect that could eventually have a bit of a price impact further down the track. So look, best guess for the moment, and the view I've got is pretty much the same as everybody else, that the prices will weaken further. Best guess is that there'll be a general bottoming of the cycle towards the middle of this year. But I don't think any of us can state with any degree of certainty exactly what the upward swing in the house price cycle is likely to look like. All I'd say is that Wellington's come down a fair distance there, and so has Auckland as well. And I do think maybe the cities, Christchurch definitely, have scope for outperformance in the coming upward leg of the cycle, lasting however many years it does, as compared with the regions where, of course, that was where activity and price increases were so phenomenally strong from about 2016 onward for a good number of years. So look, all the best out there. Let me just finish by noting that I'm still, just to repeat what I said earlier, 50-50 on whether New Zealand has a recession or not. One of the developments out there around the world is people pulling back on their predictions of unemployment rates rising. I think the labour market is still going to remain relatively tight in New Zealand, and hey, that's a key driver of what happens in the housing market. So look, thanks everybody for paying attention there, and just to note that these views are my own and not necessarily the views of NZHL, and hopefully I've put enough disclaimers along the way as well to make you realise that forecasting in this uncertain world we live in is itself a very uncertain exercise. So go and talk, if you're looking at financing, with a mortgage advisor there who is going to get you to focus a lot more on uncertainty about your income, your risk tolerance, than trying at all to pick exactly where house prices or interest rates are going to go. All the best out there. Cheers.